All right, let's jump right in. We're diving deep today into some really fundamental parts of corporate tax, specifically how businesses handle losses.
That's right. We're talking net operating losses or NOLs, and also the rules around capital losses for corporations.
Yeah, these aren't just, accounting details. They're tools businesses use constantly. So based on the source material we have, our goal today is to break down these rules, look at some specific examples, and really help you understand the mechanics.
Exactly. Knowing how these work gives you a much clearer picture of a company's financial situation, its tax strategy, and frankly, its resilience.
Absolutely. So let's start with the big one, corporate net operating losses. What exactly is an NOL in the corporate world?
Okay, so at its core, an NOL happens when a corporation's allowable tax deductions for the year are actually more than its gross income for that same year.
So basically, they lost money for tax purposes that year.
Pretty much. Their deductible expenses exceeded their income. Now, individuals can have NOLs too, but the rules for corporations, which we're focusing on based on our source material, are quite different.
And the real power isn't just having the loss, it's what you can do with it.
Right, precisely. The key is that corporations can use these NOLs to offset taxable income in other years, either past years or future years.
So it lets them smooth things out. A bad year doesn't just vanish. The loss can reduce taxes when they do make profits.
Exactly. It provides a tax benefit from the unprofitable years that can be realized in profitable ones. Think of it as a way the tax system recognizes that business cycles have ups and downs.
For you listening, understanding this helps make sense of corporate financials. Seeing a big NOL asset on the books means potential future tax savings.
It's a valuable asset, potentially. Now, a really crucial point from our source material is that the rules for how these NOLs can be used, the carryback and carry forward rules, have actually changed quite a bit over the years.
Right. It's not one size fits all. It depends on when the NOL was generated.
Absolutely critical. You have to track NOLs by their vintage year. Let's break down these periods based on the source.
Okay, where should we start? The oldest ones.
Yeah, let's start there. For NOLs that came from tax years ending on or before December 31st, 2017, so pre-2018 NOLs.
What were the rules for those?
According to the source table, these older NOLs had zero carryback. You couldn't take a 2017 loss, for instance, and use it to get a refund from, say, 2015.
Okay, no looking back for those. What about going forward?
That was the good part. They could be carried forward indefinitely, no time limit, and importantly, they could offset 100% of taxable income in those future years.
100%. So if you had $50,000 in income and a $50,000 pre-2018 NOL carry forward, you could wipe out that entire income.
Correct. Zero tax liability for that year, up to the amount of the NOL you had available. Very powerful going forward.
Got it. So indefinite carry forward, 100% offset, but no carryback. What changed after that?
Things shifted significantly for NOLs generated in tax years, starting after December 31, 2017, but before January 4 in 2021. So we're talking about NOLs from 2018, 2019, and 2020.
Okay, the TCJA era and then the CARES Act adjustments. What happened then?
For these specific years, the carryback came back. Corporations could carry these NOLs back 5 years.
5 years. So a 2020 loss could potentially get you refunds from taxes paid way back in 2015.
Exactly. And the rule was you had to carry it back to the oldest year in that 5-year window first, then move forward chronologically.
Okay, carryback is back. What about carry forward?
Still indefinite carry forward for these 2018, 2020 NOLs, just like the older ones.
So 5-year carryback, indefinite carry forward. Seems pretty generous. Was there a catch? Like, how much income could they offset?
Yes. This is where the complexity starts. For the tax years 2018, 2019, and 2020 themselves, if you used one of these NOLs, say carrying a 2019 NOL to 2020, it could still offset 100% of income. But, and this is a huge but highlighted in the source, starting in tax year 2021 and for all later years, these same 2018-2020 NOLs became subject to a new limitation. They could only offset 80% of taxable income.
Whoa, okay, so an NOL generated in 2019, if used in 2020, offsets 100%. But if that same 2019 NOL is used in 2021 or 2022, it only offsets 80% of the income in those years.
Precisely. The year you use the NOL dictates the percentage limit once we hit 2021.
And there's an ordering rule too, right, if you have both old and new NOLs?
Yes, the source points this out. You use the pre-2018 NOLs. First, those offset 100%. After those are used, then you can use the post-2017 NOLs, like the 2018-2020 ones, but they only offset 80% of the income that's left.
Man, okay. Tracking these different vintages and limits sounds critical. So what about the most recent NOLs? The ones generated in tax years ending after December 2021 onwards.
For these newest NOLs, the carryback provision went away again, so 0 years carryback.
Back to no carryback, like the pre-2018 rule.
Right. They do carry forward indefinitely, though.
And the utilization limit.
They are subject to the 80% utilization limit right from the start. So a 2022 NOL carried forward to 2023 can only offset 80% of 2023's taxable income, after any pre-2018 NOLs are used, of course.
Okay, let me try to summarize the carry rules based on the source. Pre-2018 NOLs. No carryback, indefinite forward, 100% offset. 2018-2020 NOLs. 5-year carryback, indefinite forward, 100% offset in 2018-2020, but only 80% offset from 2021 onwards. 2021 plus NOLs, no carryback, indefinite forward, 80% offset always.
That's a perfect summary of the rules outlined. It's definitely a patchwork quilt depending on the year.
And the source mentioned that even when carryback is allowed, like for those 2018-2020 NOLs, companies can choose not to do it. They can elect to only carry forward.
Yes, that election is available.
Why might they do that? Skipping a refund seems counterintuitive.
Well, maybe the tax rates in the past years were really low, so the refund wouldn't be much. They might anticipate much higher income and tax rates in the future, making the future deduction, even at 80%, more valuable in present value terms.
Ah, a strategic decision based on rate forecasting.
Or sometimes it's just simpler administratively to only carry forward, avoiding amended returns. It's a choice.
Okay, that makes sense. Now, before we see this in action, the source also lists specific adjustments needed just to calculate the NOL for the current year. This isn't about using old NOLs. It's about figuring out this year's loss amount.
Right. Certain deductions are treated differently just for this calculation. The first one mentioned is the charitable contribution deduction.
Corporations can deduct charitable gifts, usually up to a limit based on their income.
Correct. But the source is clear. For the specific purpose of calculating the current year's NOL, that deduction is not allowed. You effectively add it back if it was taken for regular tax calculation.
Interesting. A specific disallowance just for the NOL calc. What about the dividends received deduction, the DRD? That one usually has an income limitation too.
Yes, and this is a really key interaction rule highlighted in the source. Normally, the DRD is limited, often to 50% or 65% of taxable income before the DRD. However, that income limitation does not apply if taking the full DRD would either create an NOL for the year or increase an existing NOL.
Okay, walk me through that. Let's say income before DRD is $10,
Right.
and the full DRD would be $15K. Normally, the DRD might be limited to, say, 65% of $10, which is $6,500.
Right, but in this case, $10 income minus the full $15K DRD gives you a negative $5K, since that creates an NOL.
The income limitation is ignored, and you get to deduct the full $15K DRD when calculating the NOL.
Exactly. The full $15K DRD is used, resulting in that $5K NOL. It's a powerful exception ensuring the DRD doesn't artificially prevent an NOL. Very relevant for companies with lots of dividend income.
That's a crucial detail. What else is adjusted for the NOL calculation?
Another one is pretty straightforward. You cannot deduct NOL carryovers from prior years when calculating the current year's NOL.
Makes sense. This year's loss should reflect this year's operations only.
Precisely. The calculation needs to stand on its own for the current year. And finally, there's an interaction with capital losses.
Which, as we'll discuss more later, corporations can generally only use against capital gains.
That's the main rule. For the NOL calculation, the source says a corporation can deduct a capital loss carryover from a prior year against a capital gain in the current year.
So, using up an old capital loss against a current capital gain reduces the current year's total income.
Which, in turn, can help create or increase the current year's NOL. It's an indirect effect.
Okay, but the source distinguishes carryovers from carrybacks here.
Yes, it specifically says you cannot deduct a capital loss carryback from a future year against a current year capital gain when determining the current year's NOL.
Another specific timing rule. Carryovers count for this calculation. Carrybacks don't. These adjustments seem key to getting the starting NOL number right.
They definitely are. You have to apply these specific modifications.
Okay, we've defined NOLs, seen the complex carry rules, and the calculation adjustments. Let's make this concrete with the first example from the source, Johnson Corp.
Yeah, this is a great example to see the carryback and carry forward rules, especially that 80% limit kicking in.
Lay out the basics for Johnson Corp.
Okay. Johnson Corp calendar year C Corp started business in 2017. In 2020, they had a $40,000 NOL. Their taxable income before considering any NOLs was consistently $10,000 each year from 2017 through 2023. And a key detail, The tax rate was 34% in 2017, but dropped to 21% from 2018 onwards.
Got it. 40K NOL in 2020. Based on our rules, a 2020 NOL falls into that 2018-2020 bucket, so it gets a 5-year carryback.
That's step one, carry it back. And you have to start with the oldest eligible year. 5 years back from 2020 is 2015, but they only started in 2017, so 2017 is the first stop.
They had $10,000 of income in 2017, so they used $10,000 of their $40,000 NOL to offset that.
Correct. And the benefit, a refund. They paid tax on that $10,000 back in 2017 at the 34% rate.
So $10,000 times 34%, that's a $3,400 refund. Nice bit of cash back.
Exactly. Now they've used 10K of the NOL, leaving 30K, 40K, 10K. The next oldest year is 2018.
Income in 2018 was also $10,000. So you use another $10,000 of the NOL. The tax rate in 2018 was 21%.
Right. So $10,000 times 21%. That's a $2,100 refund from 2018.
Okay, $20,000 of the NOL now remains. 30K, $10. Next year is 2019.
Same story. $10,000 income, 21% rate. Use another $10,000 of the NOL.
And get another $2,100 refund from 2019.
Correct. So let's tally the carryback. They got refunds totaling $3,400 plus $2,100 plus $2,100, which is $7,600.
And they use $10 plus $10 plus 10K equals $30,000 of the NOL and the carryback.
Which means they have $10,000 of the original $40,000 NOL left, 40K, 30K. This remaining $10,000 has to be carried forward.
Okay, carrying forward $10,000 of a 2020 NOL. The first year available is 2021.
And now we hit that rule change. It's a post-2017 NOL being used in 2021, so the 80% limitation applies.
Johnson Core had $10,000 of income in 2021. They can't use the full $10 NOL against it. The limit is 80% of that income.
Right. 80% of $10,000 is $8,000. So in 2021, they can deduct $8,000 of the NOL.
That reduces their 2021 taxable income from $10,000 down to $2,000, 10K, and they still have some NOL left over.
Yep, $2,000 remaining. 10K carry forward, 8K used. This $2,000 gets carried forward to 2022.
In 2022, income is again $10,000. The 80% limit would be $8,000 again, 10K, 80%.
But they only have $2,000 of NOL left to use.
So can they use the full $2,000?
Yes. The source confirms, since the available NOL, $2,000, is less than the 80% limit, $8,000, they deduct the entire remaining $2,000 in 2022.
Okay, that reduces their 2022 income to $8,000, 10K, 2K, and importantly, the $40,000 NOL from 2020 is now completely used up.
All gone. $30 using carryback, $10 used over 2021 and 2022 and carry forward.
Looking back at this, the carryback was valuable instant cash via refunds, and the differing tax rates mattered. That 34% rate in 2017 gave a bigger refund bang for the buck than the 21% later.
Yeah. That last $10,000 of NOL, without the 80% limit, they would have used it all against the $10,000 income in 2021. Done in 1 year.
But with the 80% limit, it took 2 years, 2021 and 2022, to use up that same $10,000. It stretches out the benefit, lower present value, more complex tracking. You can see why companies need to plan around these changing rules.
Absolutely. This example really highlights the practical impact of those vintage rules and the 80% limitation.
Okay, excellent illustration. Now let's shift to another really significant limitation on using NOLs, Section 382. This kicks in after a major ownership change.
Right. Section 382 is designed to prevent what's often called NOL trafficking.
Trafficking sounds bad. What's the perceived abuse here?
The worry was that a consistently profitable company could just go out and buy a company that had huge accumulated losses, a loss corporation, mainly just to use those losses to shield the profitable company's income from tax.
So, acquiring the company primarily for its tax attributes, not necessarily its underlying business.
That was the concern. The idea behind NOLs is to help the business that incurred the losses. Letting a completely new owner use them freely seemed to Congress like it was detaching the tax benefit from the business activity that generated the loss.
Okay, so Section 382 steps in. What does it do?
It imposes an annual limit on the amount of pre-change NOLs that the loss corporation can use against its taxable income after a significant ownership change occurs.
It doesn't eliminate the NOLs, but it puts the brakes on how fast they can be used post-acquisition. So what counts as a significant ownership change to trigger this? The source has a specific definition.
It does, and it's quite technical. An ownership change happens if the stock ownership percentage of one or more 5% shareholders goes up by more than 50 percentage points compared to their lowest ownership level during the testing period.
Okay, let's unpack those terms. 5% shareholder.
That's anyone who owns 5% or more of the loss corporation's stock at any point during the testing period. Could be an individual, another company, etc.
And the testing period.
Typically, it's the 3-year period ending on the date you're testing whether an ownership change might have occurred.
So you look back 3 years. Identify everyone who owned 5% or more at any time. You track their ownership. If their total ownership percentage collectively increased by more than 50 points from their lowest collective point in that window, bang, Section 382 applies.
That's the essence of it. It's the aggregate increase that matters, and the source adds a nuance. For each shareholder, you measure their increase from their lowest percentage ownership during the testing period.
Got it. It prevents dips in ownership from minimizing the measured increase. This sounds like it needs really careful tracking of who owns what, especially over time.
Oh, absolutely. It's a major due diligence item in M&A. Let's use example 2 from the source, the ABC Corp. Case, to see how this trigger works.
Okay, what are the facts for ABC?
ABC Corp. is a loss corporation. On January 1st of year 4, 3 people, X, Y, and Z, each buy 20% of ABC stock. They're unrelated.
So after that purchase, X, Y, and Z each hold 20%.
Right. And we know X had previously bought 5% back on January 1st of year 2. Y and Z owned 0 before this year 4 purchase.
Okay, the test date is Jan 1, year 4. The testing period looks back 3 years to Jan 1, year 1. X owned 5% during that period. Y and Z owned 0%.
Correct. Now, who are the 5% shareholders during the testing period? X, Y, and Z all end up owning 20%, so they clearly are. X was also a 5% owner earlier in the period, so X, Y, and Z are our group.
Now we calculate their individual increases from their lowest point in the testing period. X, lowest point was 5%, ended at 25%, the original 5% plus the new 20%. Increase is 20 percentage points. Y, lowest point was 0%, ended at 20%, increases 20 percentage points. Z, lowest point was 0%, ended at 20%, increase is 20 percentage points.
Perfect. Now add up those increases.
20 plus 20 plus 20. That's a 60 percentage point aggregate increase.
And the threshold for an ownership change is more than 50 percentage points.
50 is definitely more than 50. So an ownership change occurred on Jan 1, year 4. Section 382 is triggered for ABC Corp.
Exactly. That transaction flips the switch. It's not just about one person gaining control. It's this collective shift among major shareholders over 3 years.
Huge implications for any deal involving a company with NOLs. So once it's triggered, how do you figure out the annual limit on using those pre-change NOLs?
Section 382 provides a formula for that annual limitation.
What's the calculation?
According to the source, you take the fair market value, FMV, of the lost corporation's stock immediately before the ownership change.
Okay, the value of the company right before the deal closes.
And you multiply that FMV by the federal long-term tax-exempt rate.
The long-term tax-exempt rate, where does that come from?
It's a rate published periodically by the IRS. It's meant to represent a sort of conservative, risk-free rate of return on capital.
So FMV times this published rate equals the maximum pre-change NOL deduction allowed each year after the change.
That's the basic annual limit.
What if the company doesn't have enough taxable income in a particular year to use up the full limit? Is that year's unused limit lost?
No, that's a good question. The source clarifies that any unused portion of the annual Section 382 limitation carries forward and increases the limitation amount in the following year.
Oh, good. So the capacity to use the NOLs accumulates if you can't use it all in 1 year.
Correct. It rolls over.
Let's apply this calculation to ABC Corp again, using example 3 from the source.
Okay. We know the ownership change happened Jan 1, year 4. ABC had $1 million in NOL carryforwards at that time. The source states the FMV of ABC's stock right before the change was $3 million, and the relevant long-term tax-exempt rate was 2%.
All right. Calculation is FMV times the rate, so $3 million.
Multiplied by 2%.
$3 million times 0.02 equals $60,000.
That $60,000 is ABC Corp's annual Section 382 limitation.
So even though they have $1 million in NOLs from before the ownership change, they can only use a maximum of $60,000 of those NOLs per year against their income in year 4 and any year after.
That's exactly what it means.
Wow. To use up the full $1 million NOL at that rate, $1 million divided by $60,000, that's almost 17 years, assuming they have enough income each year.
Precisely. It dramatically slows down the utilization of those pre-change losses.
Yeah.
It makes the NOLs much less valuable as an immediate tax shield to the acquirer.
It really forces the value proposition back to the underlying business's ability to generate future profits, which can then be offset slowly by these old losses. It definitely seems to curb that trafficking incentive.
That's the intended effect. It ties the NOL benefit more closely to the ongoing business, not just the acquisition itself.
Okay, that covers NOLs and the big Section 382 limitation. Let's switch gears now to the other type of loss in our source material, corporate capital losses.
Right. And the first thing the source emphasizes is how differently these are treated for corporations compared to individuals.
Yeah, for individuals, you offset capital gains with capital losses. But if you have leftover losses, you could deduct up to $3,000 per year against ordinary income, like salary or business income.
That $3,000 deduction against ordinary income, absolutely not allowed for corporations. That's the fundamental difference.
So what can corporations do with capital losses?
The rule is strict. Corporations can only use capital losses to offset capital gains, period. They cannot, under any circumstances, use a net capital loss to reduce their ordinary income from business operations.
Only gains offset losses. So if a company has, say, $100,000 in capital losses from stock investments, but zero capital gains that year, that $100,000 loss provides zero immediate tax benefit against their operating profit.
Correct. No offset against operating income at all.
So what happens to that $100,000 net capital loss? Is it just gone?
No, thankfully not gone forever. Like NOLs, they can be carried to other years, but the carry periods are different.
What are the carry rules for corporate capital losses, according to the source?
It's a 3-year carry back and a 5-year carry forward.
3 back, 5 forward. That's much shorter than the indefinite carry forward for NOLs, especially the newer ones.
Much shorter, particularly the 5-year forward limit. If you don't generate enough capital gains within that 5-year window to absorb the carried forward loss, it expires worthless.
Ouch. Okay, 3 back, 5 forward. Apply to the earliest year first in the carry back, carry forward period.
Yes, standard ordering. And the source notes another specific rule. When you carry a capital loss back or forward, it's always treated as a short-term capital loss in the year it's used, no matter if it started as short-term or long-term.
Always becomes short-term when carried. Got it.
Hmm.
And just to hammer it home, even when carried back or forward, it can still only offset capital gains in that carry year, right?
Absolutely. Never ordinary income, only capital gains.
Okay. Rules seem clear. Offset gains only, 3 back, 5 forward carry, become short-term when carried. Now, the source has an interesting example, Lane Core, example 4, showing an interaction between a capital loss carryover and calculating a current year NOL.
Yes, this shows that even though capital losses don't directly offset ordinary income, using a carryover can indirectly affect the NOL calculation.
It's Lane Core's situation.
Okay, Lane Core has $400,000 in total gross income. Included within that is a $150,000 capital gain. They also have $500,000 in operating expenses. And they have a $20,000 capital loss carryover from a prior year.
So looking just at operations, it seems like $400K total income, $150K capital gain equals $250K ordinary income. $250K ordinary income minus $500K expenses looks like a $250K operating loss. Plus, they have this $150K capital gain and a $20K capital loss carryover.
Right. The first step is applying that carryover. The $20,000 capital loss carryover is used to offset the $150,000 current year capital gain.
Okay, so the net capital gain for the year becomes $130,000, $150K gain, $20K carryover used.
Exactly. Now, how does this affect the NOL calculation? The source says gross income after deducting the capital loss carryover will now be $380,000.
How do they get $380K? It's the original $400K total income minus the $20K capital loss carryover that was just used.
Precisely. By using the carryover against the capital gain portion of the income, the overall income figure used for the NOL calculation is reduced.
So the NOL is calculated as this adjusted income of $380,000 minus the $500,000 operating expenses.
Correct. $380,000 minus $500,000 gives you an NOL of $120,000.
Let's compare. If they hadn't had that $20K carryover, the income figure would have been $400. The NOL would have been $400K, $500K, $100.
Right.
So by using the $20K capital loss carryover, even though it only offset a capital gain, it effectively increased the current year NOL amount by $20 from $100K up to $120K.
Exactly. It's an indirect effect. The capital loss shields some capital gain income from being considered in the NOL calculation, which makes the operating loss look larger relative to the remaining income.
That's a subtle but really important interaction. Managing capital gains and losses isn't just about the capital side. It can flow through to the NOL calculation too.
It really highlights the need for integrated tax planning. Timing of gains and losses matters across the board.
Okay, fantastic. We've covered NOL basics, the changing carry rules, Section 382, and now corporate capital losses and their interaction. The source finishes with a comprehensive example, loss cover, that seems to pull many of these pieces together.
Yes, this final example is great because it involves calculating a current year loss with different income types, deductions like the DRD, applying a capital loss carryover, and then looking at how the resulting loss fits in with existing NOL carry forward from different eras.
All right, let's set the scene for Losco.
Yep.
In the current year, 2023, what are their numbers?
For 2023, they have gross income from operations, $250,000, dividends received, $50,000, and the source implies this qualifies for a 65% DRD. Capital gains, $10,000. Other deductions like operating expenses, $280,000.
Got it. And they started 2023 with some carryforwards.
Yes. They had a capital loss carryforward of $12,000. The source schedule shows this originated from an $8,000 loss in 2020 and a $10,000 loss in 2022. The text says none had expired yet.
Okay, 18K generated, 6K used previously, 12K available. What about NOL carryforwards?
They started 2023 with $70,000 in NOL carryforwards. This consisted of $20,000 left over from a 2004 NOL and $50,000 left over from a 2019 NOL.
$20 from 2004, pre-2018 rules, and $50 from 2019 post-2017 rules. Okay, that's the setup. Let's figure out their 2023 result. Step 1 from the source is calculating income or loss before the DRD.
Okay. Income items first. Operations $250K plus dividends, $50K plus capital gains $10. That's $310,000 total gross income.
Now apply the capital loss carryforward. They have $12K available and a $10 current year capital gain.
So they used $10,000 of the available carryforward to wipe out that $10,000 capital gain. The source calculation shows subtracting this $10,000.
Right. $310,000 total income minus $10,000 capital loss used leaves $300,000.
Correct. Now subtract the other deductions of $280,000.
$300,000 minus $280,000 equals $20,000. So Losco has $20,000 of taxable income before considering the DRD.
Exactly. Now for step 2, calculate the DRD. The tentative DRD is 65% of a $50,000 dividend.
65% of 50K is $32,500.
Okay, but remember the normal limitation. It's usually limited to 65% of taxable income before the DRD. Taxable income before DRD was $20,000.
So 65% of $20,000 is $13,000. The normal limit would cap the DRD at $13,000.
However, here comes that special rule again. Does taking the full tentative DRD, $32,500, create or increase an NOL?
Let's check. Income before DRD is $20,000. Subtract the full $32,500 DRD.
$20,000, $32,500, and it's still $12,500.
Yes, it creates a loss, a negative $12,500.
Because it creates an NOL, the source confirms the normal $13,000 limitation is ignored. The full $32,500 DRD is allowed for the purpose of calculating the 2023 NOL.
That rule is huge here. It turns what looked like positive income into a loss. Okay, step 3. Calculate the actual 2023 net operating loss.
$20,000 minus $32,500 equals $12,500. Losco has a $12,500 NOL for 2023.
That's the result. And the source notes correctly that no prior year NOL carryforwards were used in this calculation. It's purely based on 2023 activity.
Okay, key results for 2023. A new $12,500 NOL generated and $10,000 of capital loss carryforward used against the capital gain. Now, the source provides updated carryforward schedules. Let's look at those. Let's start with the capital loss schedule. And this is where the source material itself seems to present an inconsistency, which we should address carefully.
Oh.
What's the issue?
Well, our calculation, following the rule that capital losses only offset capital gains, showed $10,000 of the carryforward being used against the $10,000 gain in 2023. That seems straightforward based on the rules provided.
Right. Use $10 K loss against $10 gain, leaves $2 Ks of the original 12K carryforward unused.
Exactly. However, the updated schedule shown in the source as the final result presents different utilization numbers. It shows the $8,000 loss from 2020 was fully utilized, $8,000 used in 2023. The $10,000 loss from 2022 had $8,000 utilized in 2023, leaving $2,000 carry forward. This implies a total capital loss utilization in 2023 of $8,000 plus $8,000 plus $8,000 is $16,000 according to the schedule's numbers.
Hold on. The schedule says $16,000 of capital loss was used, but Losco only had a $10,000 capital gain in 2023. How can you use $16,000 of loss against only $10,000 of gain if the rule says losses only offset gains? That doesn't add up with the rules stated earlier.
You've pinpointed the discrepancy within the source material itself. The rule explanation and the calculation steps point towards $10 utilization, limited by the $10 gain. But the final schedule presented in the source shows $16 utilized.
So how do we handle this?
Since our deep dive is based strictly on the provided source, we have to report what the source ultimately presents, even if it seems contradictory. We've explained the rule and we've walked through the calculation that seems logical, $10 used. Now we state the final outcome as shown in the source's updated schedule, acknowledging the apparent conflict.
Okay, so based on the source's final updated schedule, $16,000 total capital loss was utilized in 2023. $8K from 2020, $8 here from 2022. This leaves $2,000 of the 2022 capital loss to carry forward to 2024, and the 2020 loss is fully used per that schedule. We'll just note this schedule data appears inconsistent with the gain limitation rule also presented.
Exactly. We present the source's data faithfully, including its internal inconsistencies if they exist. Now, let's look at the updated NOL schedule. This one should be more straightforward.
Agreed. What does the NOL schedule show after 2023?
It starts with the carry forwards coming into the year, shows zero utilization in 2023 since there was a loss, and adds the new 2023 NOL. The final carry forward balances to 2024 are from 2004, $20,000 remaining. From 2019, $50,000 remaining. From 2023, the new $12,500 generated. Total NOL carry forward to 2024, $20,000 plus $50,000 plus $12,500 was $82,500.
Okay, that makes sense. $82,500 in NOLs ready to be used against future income composed of 3 different vintage years.
Correct. And the final piece of the example discusses how LOSCO would use these carry forwards if they have income in, say, 2024.
This brings us back to the ordering and limitation rules. Which NOL gets used first?
The source confirms the standard FIFO rule, oldest NOL first. So the $20,000 NOL from 2004 is tapped first.
And that's a pre-2018 NOL, so it can offset 100% of 2024 income.
Correct. Dollar for dollar offset up to $20,000 of income. But the source also reminds us about the expiration for these very old NOLs. They only lasted 20 years.
Ah, right. So the 2004 NOL would expire after 2024, if not fully used by then. Or actually, 20 years from 2004 would be end of 2024. It needs to be used in 2024 or it's gone.
Precisely. That 20-year clock is ticking. Use it or lose it by the end of 2024.
Okay, after that $20 from 2004 is potentially used, what's next?
Then they move to the post-2017 NOLs. Again, oldest first. So the $50,000 carry forward from 2019 would be used next.
Followed by the $12,500 carry forward from 2023.
Right. And both of these, the 2019 and 2023 NOLs, are being used in 2024, which is a post-2020 year.
Meaning they're subject to the 80% utilization limit.
Exactly. These NOLs can only offset 80% of whatever taxable income is left in 2024 after the 2004 pre-2018 NOL has been applied.
So if LOSCO had, say, $100 K of income in 2024, first $20 is wiped out by the 2004 NOL 100% offset. That leaves $80K of income. Against that $80K, they can use the 2019 and 2023 NOLs, but only up to 80% of that remaining income, which is $64K, $80K, 8%. They'd use the $50K from 2019 first, then $14 from 2023.
That's the perfect application of the layering. This LOSCI example really ties it all together, the current year calculation with DRD quirks, handling capital losses, even with that schedule oddity, tracking different NOL vintages, applying FIFO ordering, and using the correct 100% or 80% limitations, plus watching expiration dates.
It absolutely shows why corporate tax departments need meticulous record keeping and a deep understanding of these layered rules. It's complex stuff.
It really is. There are a lot of moving parts dictated by specific dates and thresholds.
Well, this has been an incredibly detailed exploration. We've really unpacked the mechanics of corporate net operating losses, what they are, why they're valuable tax assets.
We traced the winding path of the carryback and carry forward rules, seeing how crucial the generation year is and how that 80% limitation significantly changed things.
Yeah.
We also hit those specific adjustments for calculating the current year NOL, like that key DRD interaction.
And then we tackled Section 382, demystifying the ownership change trigger and how that annual limitation works to prevent NOL trafficking by slowing down loss utilization after a major acquisition.
We also contrasted corporate capital losses with individual rules, emphasizing the strict offset gains only rule, the shorter 3-back 5-forward carry periods, and showed how using a carryover can indirectly boost a current year NOL.
And finally, LOSCO brought it all home, showing these different rules interacting in a single year's calculation and carry-forward analysis. Hopefully, for you listening, this deep dive has brought some real clarity to how businesses manage losses for tax purposes.
Understanding these rules isn't just for tax pros. It helps anyone analyzing a company's financials, thinking about investments, or even just understanding news about corporate taxes and M&A. These rules shape real-world decisions.
Absolutely. And maybe a final thought to leave you with, something to chew on from our discussion today. Think about the broader economic consequences of these technical tax rules. How might that shift to the 80% NOL limit influence a company's willingness to invest heavily today if they anticipate future profits might still face some tax burden despite large NOL carryforwards.
Or consider Section 382. Does severely limiting the usability of NOLs after an acquisition make it harder for struggling companies to find buyers, potentially leading to more liquidations instead of turnarounds? These intricate details within the tax code really do have ripple effects on business behavior, investment choices, and the overall economic landscape. They're not just numbers on a form.